Hey everyone, and welcome to this explainer on the brand new taxation provisions under the Income Tax Act 2025. I am really excited to walk you through this material today. If you're a chartered accountant, a CA student, a tax pro, or a business owner, getting a solid grip on the structure of deductions is, well, it's absolutely vital. So today, we're zooming in specifically on Section 122 of the new Act, which governs the deductions you need to make when computing total income. Let's kick things off with a pretty fundamental question. Just imagine you've made some massive investments this tax year, maybe even exceeding what you actually earned. So can your tax deductions ever exceed your gross total income? Meaning, could you end up with a negative income or a loss based strictly on those deductions? Keep that scenario in the back of your mind because the answer is really the absolute cornerstone of Section 122, and it literally dictates how every single computation gets finalized under the new tax regime. All right, so here is our roadmap. We'll cover an introduction to Section 122, breaking down the law, a practical taxation example, compliance and practical issues, and finally, a summary of key takeaways. Section 1, Introduction to Section 122. So, within the framework of the Income Tax Act 2025, Chapter 8 is what dictates your deductions, and Section 122, think of that as your gateway rulebook. Its main goal is to lay down the overarching general principles for how and exactly to what extent these deductions can be claimed. Now, for those of you already familiar with the old regime, you'll remember these principles lived in Section 80A of the 1961 Act. Under the new Section 122 of the 2025 Act, the official transition FAQs make it super clear the core principle hasn't changed at all. The new law basically just modernizes the framework while keeping that exact same foundational logic that tax professionals have relied on for literally decades. Section 2, Breaking down the law. Right, so the absolute starting point for our calculation is gross total income, or GTI for short. As per Section 122, subsection 10, this is your total income figured out across all the different heads, salary, house property, business or profession, capital gains, and other sources, after you've applied any clubbing provisions and set-offs. But, and this is crucial, strictly before making any deductions under Chapter 8I. This GTI is your baseline. It's the specific number from which Chapter 8I deductions are actually allowed. And that brings us right to the most critical rules within the provision, which you'll find in subsections 1 and 2 of Section 122. First off, the law explicitly states that deductions specified in this chapter shall be allowed from the gross total income. But here is the big answer to that hook question we asked earlier. The aggregate amount of the deductions under this chapter shall not, in any case, exceed the gross total income of the assessee. You cannot use Chapter 8 deductions to drive your taxable income below zero. No way. If your gross total income is a specific amount, your maximum allowable deduction is hard capped at exactly that amount. Now, Section 122 also packs in some specific safeguards, like the limitation found in subsection 3. This one is all about preventing double dipping. It basically lays out that if a deduction under specific sections, such as 133, 135, 137, or 138, is allowable to an association of persons, an AOP, or a body of individuals, a BOI, then no deduction under the same section can be claimed again by a member of that AOP or BOI in relation to their share of the income. It's pretty straightforward. The law ensures that the tax benefit is handed out exactly once. Section 3, a practical taxation example. Let's put some real numbers to this to see how it actually plays out for a taxpayer. Imagine we have an individual assessee who has computed a gross total income of exactly 100,000 rupees for the tax year. During that same year, they went ahead and made investments in specified savings instruments under Section 123, which, by the way, is the new equivalent of the old Section 80C. Let's say they invested 150,000 rupees, hitting the absolute maximum limit allowed under Schedule XV. Now, even though their eligible investment is 1.5 lakhs, Section 122, subsection 2 steps in and overrides that. Because aggregate deductions just cannot exceed gross total income, the final allowed deduction is restricted to exactly 100,000 rupees. So their taxable income drops to nil, and that leftover $50,000 investment, well, it provides absolutely no tax benefit for this year. Moving on to Section 4, Compliance and Practical Issues. When we talk about mandatory filing, Section 122, subsection 5 of the Income Tax Act 2025 is incredibly strict. Furnishing your return of income within the prescribed due date is a hard statutory precondition for claiming specific deductions under Part C of Chapter 8. If you file a belated return, you literally forfeit these deductions entirely. The official transition FAQs point out that this is just continuing the strict legislative policy we used to see enforced by Section 80AC of the old Act. Bottom line, timely compliance is totally non-negotiable. So, what are the common pitfalls we see out there? First, just like we discussed, missing that filing deadline under 122.5 leads to an outright denial of your claims. You definitely don't want that. Second, there's a super common misconception about carrying forward unabsorbed deductions. Remember our earlier example where that 50,000 rupees of the Section 123 investment wasn't utilized? Well, that amount simply lapses. Chapter 8 deductions cannot be carried forward as a loss. Finally, a huge practical issue right now during this transition period is using outdated statutory references in employer payroll systems or tax audit reports. For example, people are still citing the old Section 80C instead of the new Section 123 read with Schedule X fee. As professionals, we absolutely must update all our templates to the 2025 Act standards. Section 5. Summary of Key Takeaways. Here are the 4 big pillars you absolutely need to remember about Section 122. 1. Aggregate deductions under Chapter 8 can never, ever exceed the assessee's gross total income. 2. Double deductions for associations of persons, bodies of individuals, and their members are explicitly restricted by subsection 3. 3. Filing your return of income on time is a mandatory requirement to claim Part C deductions under subsection 5. And 4. The foundational principles of Section 122 seamlessly continue the legacy of the old Section 80A, ensuring a super smooth transition for taxpayers and professionals alike under the Income Tax Act 2025. As we fully transition into the Income Tax Act 2025, it's worth asking yourself, have you actually updated all your tax planning models to reflect these hard caps under Section 122? Or are you maybe still relying on outdated assumptions that could end up costing your clients dearly? Definitely something to think about. Thank you for watching. Please like, subscribe, and share. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.